To better understand how the big, beautiful bill came about, we must go back all the way to 2017. In 2017, the first Trump tax bill came through Congress, and the compromise to get many things passed or agreed to or just friendship, get something done, was to have those changes sunset, read expire in 2025. The concept was that Trump would possibly have been in office for 2 terms. Well, most people thought those would be 2017 to 2025. As we know, it didn't quite turn out that way. At that point, the Democratic Party would need to provide a winning candidate, have a different balance of power in Congress, and could then adjust the laws to their liking. As we know, history changed things, and Trump was not in office for 8 years, but only 4. We had a Democratic Party it was unable to make significant changes to the tax law during their 4-year term, and Trump is back in 2025. So many of the provisions that were set to expire have now been extended, made permanent, adjusted, all sorts of variations of the above. As a result, we have a new, big, beautiful bill. Shawn, let's get this started.
Do it.
So thank you for joining us as we review the One Big Beautiful Tax Act of 2025. Before we start, I know some of you may not think that it's big or beautiful. A little history lesson about naming congressional acts. Back in 1982, Congress passed the Tax Equity and Fiscal Responsibility Act. Reflecting over the last 43 years, can I get a show of hands? How many of you think the tax laws have been equal and the government has been fiscally responsible? I don't see any hands. But if nothing else, it eliminates months of extreme uncertainty about the tax laws and financial and estate planning rules. And knowing what the rules are, whether we like them or not, we can now advise you and help you plan in the coming years. I'm sure you're aware after much wailing and gnashing of teeth, it finally passed. During the political campaign, we heard this will be taxed, that will be tax exempt. We need to pay our fair share, whatever that is. So, Shawn and I want to review the reality of what actually did change and what has remained the same. Today's presentation will address the act. We're not going to do a deep dive. We're just going to hit the high points that you may determine, okay, what impacts my business, what impacts my family, and what impacts you personally. Shawn, help us out.
All right. So this slide should be very familiar to many of you who attended our November 14th session that we hosted, namely, the election is over, now what? To try and give everyone a little sense of peace about all that was happening during the election, leading up to the election. That's why we did that presentation. One of our main focal points was the potential impacts of campaign promises. In many ways, what was absolute campaign fervor or rhetoric landed just about where we thought it would. If you remember that, Marshall.
Absolutely.
While eliminating tax on Social Security was top of the agenda, we knew it could not pass with this margin of control in the House and Senate. However, a temporary and highly beneficial tax deduction for seniors was added to provide some temporary relief. Just one example of the many campaign concepts that were out there but didn't quite get where it needed to be. So there's quite a bit more to unpack regarding the big beautiful bill, as they call it. And as promised, we are here to run through many of those provisions impacting you. So, Marshall, why don't we do a little different? Why don't you kick us off on the individual side?
All right. I'll do a little bit of the individual positions and provisions, and I'll punt it to you for some business stuff. So
Perfect.
let's look at the key provisions for individuals and estate taxes, because that's kind of the personal side. Back with the Tax Cuts and Jobs Act that we had back in 2017, the act that I referred to a little bit earlier, there were 7 tax brackets. These were clearly defined. They range from 10% to 37%. Well, basically, what the new big, beautiful bill has done is that it's made those rates permanent. And not all of the brackets continue to be indexed for inflation after this year. We do get inflation adjustments for the 10 and the 12%, which are the lower income taxpayers. If you're single, that gets you up to about 50 grand. If you're married, it gets you about to 100 grand if you're filing a joint return. So not real dramatic moves in those brackets. going forward. And not, again, not all of them are going to be adjusted for inflation coming up in the future. We had the standard deduction. No surprise here, the standard deduction will remain in place with an increase in 2025 to 31.5 married, 23,625 had a household, and 15,750 for individuals. And there will be ongoing inflationary adjustments. With a higher standard deduction, of course, there are fewer returns to audit. It's just whatever status you filed under, that's what the deduction is. This is a good thing since there are fewer IRS staff to perform the audits. These amounts will be indexed for inflation again after 2025. The bonus deduction for older adults. Hey, being a senior has its advantages for once. The legislation does not include President Trump's proposal eliminating taxes on Social Security benefits. Shawn touched base on that. Didn't make it across the goal line. Nobody in this office ever thought it would. But sure sounded good if you're 65 and on Social Security. So Social Security, of course, is taxable. The tax on that is if you're over 34,000 for a couple, or your combined income is over 44, you got taxes to pay. However, the additional $6,000 deduction that we have now for people who are 65 and older may help offset some of the taxes on Social Security benefits for some individuals with incomes at these thresholds. Now, I highlighted 2028 in there because this is only a 4-year provision. This is the first one I'm going to show you where, back to my opening comment about passing a law in 2017 that kicked it down the road for 8 years of a potential Trump administration. And now we've got provisions that kick it down the road 4 years of the potential for Trump not being in office, Republicans not having controls, and the Democrats being back in the lead. That can happen, obviously. Who knows what will happen by then? But you're going to see a lot of provisions that do expire. So this is the substitute for the no tax on Social Security. While they're still taxed, this deduction will at least offset a little of that tax and that income. So there's no guarantee of anything in there, but it helps. The bad news is that this lost revenue could likely bring Social Security to insolvency as much as 2 years earlier, depending on which study you read, from the current projection of being insolvent in 9 years. For those with incomes up to $500,000, the maximum deduction for state and local taxes is going to jump. Now, you probably heard this referred to as SALT. This is the SALT tax deduction. And the SALT tax deduction had been capped at $10,000. So now one of the compromises for state and local taxes is it's 40 grand, and that goes all the way through 25 and 29, and then it reverts back to 10 grand in 2030. Obviously, you see the gamesmanship here. After 2030, it goes back to the 10. And of course, if your income is over $500,000, it gets phased out. So there's a lot of caveats and calculations that go on in there. The child tax credit, move that a little quickly. The maximum credit has moved from $2,000 per child to $2,200 per child. So having a child just got $200 better, and I'm sure that you can support a child on $2,200, at least for the month of January. And so having this come into play gives a little more help, again, for those who have children, have expenses. There is a refundable portion of that. So if you, for example, if your total taxes that you would owe would be $500, you would use $500 of the tax credit to pay the taxes, and you can get a refund of $1,700 that you didn't pay in. So that's pretty sweet. So this is, again, to help the lower income taxpayer who has children. I don't think you'll get too much argument from anybody on that. Estate and gift tax. This is huge.
Huge.
The estate and gift tax is now $15 million per person, $30 million if you're married and you're joint at the end of 2026. So your family, the married couple, could have $30 million of estate assets when they pass away. And as long as they title it right, do it right, they would have zero estate tax. Well, that's pretty strong. These levels are permanent and they're going to be indexed for inflation. They were scheduled to expire at the end of 2025. So when we look at that from a financial planning standpoint, for Shawn and I to sit down with a couple and, for the last few years, we didn't know if this was going to revert back to $3 million, $1 million. You just didn't know what the rules were going to be. So it was horribly tough to plan with a couple and do their estate planning. So this is a huge victory in our world from an estate planning perspective. Tax on tips. We heard, let's do no tax on tips, big campaign promise. Well, okay, there's a phase out on this. 150,000 if you're single, if your income is that or less, you can deduct $25,000 of tip income. If you're married filing joint, under 300,000, you can deduct the 25,000 twice. So you can deduct 50,000 on the return. This is huge if you work in a tip and services oriented industry. Same thing with overtime pay. We heard no tax on overtime pay. Well, here's a new provision that you can deduct up to 12.5 per taxpayer. So that's 25 grand. This is a nice one. It too gets phased out and it expires in 2028. Here's a new twist. Interest or auto loan interest deduction. You may recall years ago you could deduct the interest on your auto loan. No big deal. It was part of this normal itemized deductions. That was done away with. Well, now you can deduct up to $10,000 of annual interest on new loans. Has to be a new loan generated in 2025, and you can deduct it through 2028. But that auto had to be U.S. assembled. So that Ferrari you were thinking about probably isn't going to fly, Shawn. You may have to dress that down just a little bit. Trump accounts for child savings. What better reason to go out and have a child than you'll get a one-time $1,000 in a gift called a Trump account. I'm sure there are some families who probably will have to refer to it under a different name because Trump is a dirty word in their house. Well, if it's a clean word in your house and you have a child that gets born or has been born in 2025 and is born through 2028, there's a new account called a Trump investment account where the money can grow tax deferred, potentially tax free. It's got a lot of quirks to it, as I'm sure you would imagine. We'd be glad to go over those with you, but at least this thing exists. One that I'm really big on that I really like is that if you don't itemize, you can deduct some charitable contributions. It's $1,000 if you're single, $2,000 if you're married. It's permanent after this year, but that's the nice thing is that you can have charitable donations that you get to deduct, but you don't have to itemize to get them. Some of the also notable things, the TCJA, the 2017 Act was a lot in there was made permanent and things were indexed due to inflation. Too many to go through. You may remember you used to get a personal exemption for yourself and for a dependent child. Personal exemptions are gone. They've been gone for a few years now. The mortgage interest deduction cap of 750,000 was made permanent. So if you have a mortgage that's 750 in principal or below, you can deduct all the interest. If it's above 750, you have to prorate. The adoption credit is now refundable and it's going to be indexed for inflation. Great for those families who are adopting children, giving them a loving home. And then 529 plans, a really cool thing. If you are getting extra credentials, such as the CPA exam, and you take a CPA review course, the fees for those types of things are now a deductible 529 or accredited 529 type expense. So another way to spend some of those $529 to get yourself into the profession. Now, been some alterations to the student loan program. If you have student loans or thinking about student loans, you want to take a look at this because there's new ceiling levels on student borrowing and some limits on Pell Grants, but there's some tricky stuff in here. Another one is the tax credits on green energy. I'm waiting to hear from Greta Thunberg on this one, but there's a lot of phase out on green energy and electric vehicles. And September 30th of this year is the elimination for cars and a rule that wind, solar, and other renewable fuel projects must be in operation by 2027. So you got 2 years to get those babies rolling to qualify for the incentives. Lots of personal provisions, and I know some of those affect everyone, and there's just about something for everybody in there. So, Shawn, help us out. Tell us about some of these major business provisions.
Thanks, Marshall. Yeah, there's something for everyone on the personal side, and I would say for my small business owners out there, there's something for everyone there too. Lots of great big tax breaks in this one big beautiful bill. So let's dive right into that. Up first is the QBI deduction. Talk a little bit about that. It's a benefit for small business owners passing business income through to their personal returns. This deduction was originally created to balance the scales, if you will. When the TCJA of 2017 passed, it lowered the corporate tax rate. So it kind of unfairly benefited big corporations and kind of left the small business owners out to dry. And that corporate tax rate dropped to 21%. So to kind of balance those scales, the QBI deduction was allowed for small business owners to deduct up to 20% of their income on their personal tax return, their business income from their personal tax return. But again, good news for small business owners. The QBI deduction has now been made permanent and benefits a few more small business owners through an increase in the income phase outs, which in part of the TCJA was 50,000 to 100,000. It would start phasing out, and over 75,000 for single and over 150 for married. There was no more QBI deduction, so benefits a little bit more small business owners. One complication related to the pass-through entities is the deductibility of state and local tax. Um, I know this has been in a lot of the news lately. This is one of those things I think that held up the House bill from moving on. But whether the entity itself can fully deduct the salt, or should it pass it through to the owners and be subject to that salt limitation, which has been 10K until now. Again, that was a lot of that discrepancy in the House before it went to the Senate. Now the Senate voted on it, pushed it back down. But the one big beautiful, or is it? Yeah, the one big beautiful bill now allows that pass-through entities to fully deduct salt at the entity level. So there's no limitation at the entity level. And as Marshall mentioned earlier in his slides, for individuals, that salt limitation is 40K. So had this not gotten passed, and they would have limited what businesses could deduct, and you would have been stuck to that 40K limitation on the individual side. So kind of good news there. I love how they increased that limit from 10K to 40K. It should make a lot of folks happy out there. One of my favorite, albeit minor, change was the increase in reporting requirements for Form 1099 NEC and 1099 miscellaneous. So a lot of my Etsy fans out there may like this one, or Etsy business owners. We all know the former $600 requirement. If you have a subcontractor that you pay $600 or more, you are required to provide them with a 1099. Well, that amount is now $2,000. Hopefully that gives some of you smaller business owners out there a little less to worry about at year end. That doesn't mean for those who don't receive their 1099 that you should not report that income. You still must report that income whether you get a 1099 or not. So keep that in mind.
Hey, Shawn, a little note on that. Remind
Yeah,
everyone about that for 2025, it's still 600. That's one of those quick timing things in the bill. So
that's right.
out this year.
Yep, good point. That doesn't happen until 2026. That goes into effect 2026. Thank you, Marshall. Good catch.
Yep.
But moving on to the next slide here. Speaking of 1099s, everyone may remember the contentious issue of the requirement to issue 1099s, more specifically 1099K, on sales done through third-party settlement organizations. Think Venmo, Zelle, Cash App, PayPal. That whole debacle has been settled, done. One big beautiful bill cleaned it up by reinstating the pre-American Rescue Plan Act of 21 thresholds of 20,000 in payments and over 200 transactions. You may remember there was some when the American Rescue Plan came into play, they were trying to bring that 1099K requirement all the way down to $600. No one could implement it, so the government gave a little bit more time. Congress gave it a little bit more time to get it there. Good news is the one big beautiful bill has brought it back to pre-American Rescue Plan levels. Again, 20,000 in payments or 200 transactions. Again, going back to my Etsy folks, that doesn't mean you don't have to report the income. It's really more a benefit for the third-party payment apps and their reporting burden. All
What?
right. Yeah. All right. So this next one should make all my business owners super, super happy. I had a conversation at lunch today, Marshall, a good friend of mine and business owner. The bonus depreciation is back, baby, and it's here to stay. This provision has been made permanent. Equipment purchased for use in your business is now 100% deductible as bonus deduction, as long as it was bought after January 19th of this year. So there's that weird, 2, 3 week gap in there. As long as you bought the equipment after 19, we can use it this year. But going forward, any equipment you buy for your business is deductible, 100% deductible. I know you all have heard Marshall or I say, please don't let the tax tail wag the dog. So please don't go rushing out, buying a bunch of equipment for that tax break. But if your business needs it, you now have a little more of an incentive to take on that purchase. In the same vein of bonus depreciation is Section 179, small business expensing. Gets a little complex here, but in basic terms, the 179 still has its place, as not all business assets can utilize bonus depreciation, right? This is mainly for my real estate folks. So if you're in real estate, this does kind of apply to you. But with that, both the phase out and the maximum amount of expense have increased to 2.5 million in expense, and it starts phasing out after 4 million thresholds. Marshall, I think I covered that quite well. Anything to add there? Or are we good?
No, I think we're good.
All right. I know the last two topics can be complex. With the bonus depreciation section 170, section 179 expensing. So if they impact you think they do, shameless plug, please reach out to Marshall and I will help you get that sorted out. It's what we do. So again, the honorable mentions, as we like to call them, some very important other legislation that was part of the OBBB. Tried something different there, but there are a few items worth mentioning. So there, just for clarity, there was no change in the corporate tax rate. That's what was made permanent in the TCJA, Tax Cuts and Jobs Act of 2017. Hence the QBI for small business owners. It's still permanent. It wasn't even talked about in this one, but just wanted to throw that out there. For any of you who do the direct free filing with the IRS, that was set to expire. The good news is it's not going to expire yet. It most likely will be available for 26. But the bill will provide that program be reviewed with the goal of making it more widely available and usable. And if the $6.5 million they put in the bill to research that doesn't come back with positive results, that may actually go away. So a small little tidbit. Section 46(1)(I) expense loss limitations. The NOL carry forward rules were made permanent in the past. There was carry back, carry forward, all kinds of crazy rules. Now, if you have a net operating loss, those carry forward rules are now permanent. Couple more here real quick. Employee retention credits. If you're still waiting on Q3 or Q4 21 payments, please don't hold your breath. Matter of fact, the bill is going to be looking into, or the folks are going to be looking into tighter enforcement on bad actors who were claiming that credit for those periods. So if you are in that situation, Marshall and I can get you to some folks that can help, but just so you know, they're going to be looking into that. Employer provided child care credit increased to 40% and up to 50% for small businesses with a limitation of 500K to 600K respectively. So if your small business is providing child care, awesome, you get a credit for that. R&D expensing. This has been very much very much fought over issue the last couple of years on whether or not research and development costs should be expensed directly or amortized over a 15-year period. The good news is with this one big beautiful bill, it now allows for full expensing for domestic R&D work, and the 15-year amortization is still around for the foreign R&D work. So may be retroactive back to 2022. You have to amend your returns to get that. Again, if you're in that situation where you think you qualify for the R&D, or you've already taken it and you're amortizing it, you can amend and go back. May or may not be worth doing, but that's where you hire a tax professional and take a look at that. Last two honorable mentions here on this slide. I think we got some more on the next one, but is tip credit. There is a FICA credit for payroll taxes paid on tips. And that has now been expanded to beauty service industry. A lot of folks who do manicures and pedicures and so on and so forth do receive tips. And for the payroll that's being paid on that credit now can expand to those organizations. I'm not a fan of this one. I kind of like the intent of it, but I understand it. The work opportunity tax credit expires at the end of this year. I always think about veterans. Companies were benefited for hiring veterans that met certain circumstances. They had up to a $6,000 credit for first year wages. again, for select classes, mainly veterans, that will expire at the end of this year. So if you're looking to do a hire, you might want to get that done, especially if you're going to hire veterans and take advantage of that work opportunity tax credit. So I think we've got one or two more here. Yep, just one more. So large college university endowments taxes on net investment income will climb up to 8% for institutions with the wealthiest holdings from the existing rate of 1.4%. Sorry, Harvard. So that about does it for the impacts of the majority, I would say, business impacts on the One Big Beautiful Bill. There are a lot more provisions out there we did not cover, like Marshall mentioned. Know that we are aware of most of them. So if you are a client of ours or wanting to know something more specific, reach out to us or reach out to your tax professional. They'll be able to dig into that for you. Again, if you're not a client and have questions, please don't hesitate to reach out. I'll have a slide a little later down in the presentation for you. We'll pause on that for a second, let you grab our contact information and take it from there. So before I move on, or before we turn back over to Marshall to close us out, there's a pretty big win for Florida that I don't know that there's been much fervor about or much talk about, as I'd like to say on this slide. But wait, there's more. On July 3rd of this year, Governor DeSantis, and I'd like to make a note here, Marshall, that I like to believe that Governor DeSantis and President Trump are very competitive people. And I imagine Governor DeSantis is touting that he signed his bill the day before Trump signed his. I just wonder if that's what's going on. But anyway, Governor DeSantis signed House Bill 7031, which repeals sales tax on commercial rent. That's right. No more sales tax on commercial rent in Florida beginning October 1st of 2025. Please, please, please don't play games with this. State of Florida is going to be looking heavily at where you're shifting rent. They're going to look back at economic impact and occupancy. If you're in that rental or whatever and you're shifting funds around, they're going to impute it back to the right period. So just ride it out. You'll be free and clear October 1st. All right, Marshall, I think that covers the individual provision. Sorry, but thank you for covering all the individual provisions and allowing me to go through the corporate. I know there's a lot of information out there for folks to chew on, so I hope we made it make a little more sense. So, how about Marshall? What else can tax preparers, excuse me, we are tax preparers, taxpayers do to maximize the benefits they can take advantage of?
Well, I think the key is that now we have knowledge on tax planning.
Right.
It's been such a challenge. I'm speaking for both of us, but it's been a challenge sitting with clients. And well, if Congress passes this, then this. If they can't pass that, then that. And well, you're a state. We might have to do some shifting and titling because you don't want this. It's been a mess. So now we actually know what the rules are. So if we can help, let us know. Based on the provisions we see so far, not much is urgent, but many clients we've been saying, wait until we know the rules. I don't want to make a bad decision for a client and then Congress pass things, the wrong way and make it a bad decision. Anyway, we now know the rules. Let's get your plans buttoned up. Now, coming up, thank you for taking time to listen for our thoughts. Our next scheduled event will be our Q2 economic update. It's going to be held as usual, the last Thursday of the month, July 31st at 10 a.m. Lots of fun things happening between now and then, labor information, inflation information, GDP information, and oh, the feds are going to meet the day before we have the economic update. So lots to cover, lots that I think that you'll find of value. As Shawn alluded to, here's our contact information. We're there for you. Just give us a call. We're more than happy to answer your questions. And it's only 1,000-page bill, so don't be surprised if we give you the we're not sure. Let us research that and get back to you answer. We've got a pretty good idea of everything, but a lot of it's new, but we want to make sure we get you good, solid information that you can make intelligent, informed decisions about. So anyway, thank you for watching. We look forward to meeting with you soon. Take care. Stay safe. See you July 31st.